Hello everyone, I am Bhala. Welcome back to a new video. In this video, we are going to look into a summary of the book, The Warren Buffett Way, one of the famous and the most intelligent person's way of investing. And these are the contents of the book. There are 8 different chapters. And the first 2 chapters, the first chapter, the 5 Sigma event, and the second chapter, the education of Warren Buffett, have been covered in the earlier videos. And in this video we are going to see the summary of the third chapter, buying a business, the 12 immutable tenets. So let's go and look into the first topic, buying a business, the 12 immutable tenets. First of all, what is tenets? Tenets are nothing but the principles in buying a business. So here Warren Buffett says about 12 important principles what to be considered while buying a business. And he divided the principles into 4 different ways. First is the business tenets, second is the management tenets, third is the financial tenets, and fourth is the market tenets. And coming to a business tenets, first he addresses 3 questions. One is the business simple and understandable? Second, does the business have a consistent operating history? Third, does the business have long-term favorable prospects? And coming to management tenets, first question is management rational? Second is management candid with the shareholders? Candid is true. Third question is does the management resist the institutional imperative? The third is financial tenets. Whether the management is focusing on the return on equity and not on earnings per share. And whether they are calculating owners' earnings and look for companies with high profit margins. And for every dollar retained, make sure the company has created at least $1 of its market value. And the last, market tenets. What is the value of the business? Second, the business can be purchased at a significant discount to its value. So these are the 12 tenets which should be considered while buying a businesses. And so in the second topic, we'll go detail into a business tenets. So in the second topic, we will be going detailed towards the business tenets. Let's go into business tenets. So as it's rightly told, there are 3. It is divided into 3 types. One is the simple and understandable. Second is consistent operating history. Third is favorable long-term prospects. A business should have all these qualities. What does the Warren Buffett says by means of simple and understandable? First, Buffett only invests if he completely aware of how the business operates. Second, investment success is not a matter of how much you know, but realistically you define what you don't know. That's very important. It's not how much you know, it's about what you don't know. You should be sure about it. Third is invest in your circle of competence, where your area of interest is, where your area of excellence is. Invest there. Fourth is, it's not how big the circle is that counts, but it's how well you define the parameters. So the circle can be small, but the parameters should be perfect. So that's what it counts actually. And consistent operating history. So Buffett avoids purchasing companies that are solving difficult business problems. Severe change and exceptional returns usually don't mix together. Buffett even admits Charlie and I have not learned how to solve difficult business problems. They took easy problems and solved those things. Looking for good businesses at reasonable price can be more profitable than difficult businesses at cheaper prices. Concentrated on identifying 1 foot hurdles that we could step over rather than trying to clear 7 footers. We should go step by step, not once at a go. For some unexplained reason, says Buffett, investors are so infatuated with what tomorrow may bring and they ignore today's business reality. And third is favorable long-term prospects. A franchise is a company providing a product or service that is needed or desired, has no close substitutive, and is not regulated. Buffett often divides the economic world into two unequal parts: small group of great businesses which he determines franchises, and a much larger group of bad businesses. Second is the key to investing is determining the competitive advantage of any given company, and above all the durability of the advantage. The third is the commodity businesses generally are low returning businesses and prime candidates for profit trouble. And the fourth point is a key to determining the long-term profit of a commodity business is the ratio of supply tight to supply ample years. So these are the three topics in the business tenets, and now we will be moving towards the management tenets. So coming to management tenets, Buffett looks very at the quality of management. He just as thorough when it comes to management of a companies whose stock he has under consideration. And in particular, he looks for three tenets. One is rationality, second is the candor, third is the institutional operative, and fourth is the taking the measurement of the management. So what does he mean by rationality? The most important management act is the allocation of company's capital, and it is the most important because allocation of capital over time determines shareholders' value. So first, ignoring the problem and continuing to reinvest at the below average rates. Second, it can buy growth. Third, it can return the money to shareholders. So these are the three rationality which Buffett looks. And the second important topic is initiating a dividend and buying back shares. Initiating dividend means with cash in hand from their dividends, shareholders have the opportunity to look elsewhere for higher returns. On the surface, this seems like a good deal, and therefore many people view increased dividends as a sign of companies are doing well. Buying back shares. If the stock is selling below its intrinsic value, then purchasing shares make good business sense. If a company's stock price is 50 and its intrinsic value is 100, then each time the management buys back its stock, it is accruing $2 for intrinsic value for every $1 spent, which is very essential. Second is a candor. Generally, it works on the principle of generally accepted accounting principles, GAAP, GAAP. First is the question that arises is the approximately how much is the company worth. Second is what is the likelihood that it can meet its future obligations. Third question is how good a job of its managers doing given the hand they have been dealt. What needs to be reported, argues Buffett. So coming to a candor, so first is the mistakes of the first 25 years. Second, the CEO who misleads others in public eventually misleads himself in private. So the CEO should be frank with public. And the third point is he credits Charlie for helping him understand the value of studying one's mistakes rather than concentrating only on successes. Buffett always acts in the way he speaks. One example is that in the 1989 Berkshire Hathaway annual report, he stated a practice of listing his mistakes formally. Not only mistakes but also opportunities lost because he failed to act appropriately. So it's very essential to look into our mistakes also. The next topic is institutional imperative. First, the organization that resists any change in its current direction. Second, just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. Third point is any business craving for the leader, however foolish, will quickly be supported by detailed rate of return and strategic studies prepared by its troops. And the fourth point is mindless limitations of their peers, whether they are expanding, acquiring, or setting executive compensation or whatever will be mindlessly imitated. Taking the measure to a management. This is the next topic. Some other opinion like Buffett would be first to admit that evaluating managers along these dimensions like rationality, candor, and independent thinking is more difficult than measuring financial performance. For a simple reason that the human beings are more complex than numbers. So, first, the value of management is fully reflected in the company's performance statistics, including sales, profit margin, return on equity, and no other measuring stick is necessary. And no matter how impressive management is or how good the industry is, he will not invest in the people or industry alone, because even the brightest and the most capable managers cannot rescue a very difficult business at the point. Taking the time to evaluate management yields early warning signs of eventual financial performance. And the fourth is, when the management with a reputation for brilliance tackles a business with a reputation for poor in fundamental economics, it is the reputation of the business that stays intact. So these are the points in the taking to measure to management. And the next topic is the financial tenets. Buffett is always guided by these four principles in financial. One is return on equity. Second is the owner's earnings. Third is the profit margins. And fourth is the $1 precise. That is, for every $1 retained, make sure the company has created at least $1 of market value. So what is return on equity? Buffett considers earnings per share a smoke screen. Smoke screen in the sense it is a glitch. Buffett believes that a business should achieve good returns on equity while employing little or no debt. So without taking any major loans, if a company can able to achieve good returns, then the company is good. Third, to measure a company's annual performance, Buffett prefers return on equity, the ratio of operating earnings to shareholders' equity. The second topic is owner's earnings. Because inflation exacts the toll on asset-heavy businesses, the earnings of these companies take a mirage-like quality, which might not be true. So, accounting earnings are useful to the analyst only if they approximate the company's expected cash flow. But you cannot focus on cash flow, Buffett wants, unless you are willing to subtract the necessary capital expenditures. Instead of cash flow, Buffett prefers to use what he calls owner's earnings, a company's net worth plus depreciation, depletion and amortization, less the amount of capital expenditures and any additional working capital that might be needed. Yeah, it might look a little complex, but it's a simple formula which Buffett employs to calculate the owner's earnings. And the next topic is profit margins. So, Buffett is aware that a great business makes lousy investments if management cannot convert sales into profits. Second is, there is no big secret to profitability. It all comes down to controlling cost. The third point is, right size stop for any business operations and believes that for every dollar of sales there is an appropriate level of expenses. Exactly. So we can't have n number of staffs as possible, and we should have less number of staffs also. So the staffs should be appropriate for the businesses which occurs. And the fourth point is, most companies of Berkshire's size have corporate expenses 10 times higher than Berkshire's itself. Exactly. So how you control your expenses of your companies becomes very essential in terms of calculating the profit margins. So $1 premise. First point is, Buffett has created a quick test to judge not only the economic attractiveness of a business but how well the management has accomplished its goal of creating shareholders value, the $1 rule. Second, the increase in the value should at least match the amount of retained earnings dollar for dollar. If the values goes up more than the retained earnings, so much the better. Within the gigantic auction arena, it is our job to select the businesses with economic characteristic allowing each dollar of retained earnings to be translated eventually into at least $1 of market value. So these are the $1 premise, and next we will be going into a market tenets. So is this a good value, and is this a good time to buy it? That's the price favorable. So first determine the value, second buy at attractive price. These are the two market tenets which Buffett discussed. So what does he mean by determining the value? Low price to earnings ratio, low price to book values, and high dividend yields. The value of a business is determined by the net cash flow expected to occur over the life of a business, discounted at an appropriate interest rate. The best system, according to Warren Buffett, by John Burr Williams in his book The Theory of Investment Value. Second is the buying at attractive price. So Buffett's intention is not only to identify businesses that earn above average returns, but to purchase them at a price far below its indicated value. Graham taught the importance of buying a stock only when the difference between the price and its value represents a margin of safety. Exactly. The margin of safety principle assists Buffett in two ways. First, it protects him from downside price risk. If he buys up at a particular price, if there is a downside, still it protects him. Second, it also provides opportunities for extraordinary stock returns. Since he buys at a very low level, he can get enormous returns. So these are two things in market tenets. And the last topic in this chapter is anatomy of a long-term stocks price. Yeah, for readers who more readily process information visually, so the author created a graphic. It shows in concentrated form most of the key ingredients of Buffett's approach. A great business, center column, over time x-axis will produce a rising shareholder value, y-axis, as long as it is bought at a good price. And managerial decisions and avoid extinction in the market. Do better than simply matching the market rate. Instead, lead to increased value in the business. Take a screenshot of this chart and have a closer view. You will get more understanding. The intelligent investor. Yeah. The most distinguishing trait of Buffett investment philosophy is the clear understanding that owning a shares of a stock, he owns businesses. By owning a shares, he doesn't own only shares. He thinks it's the business he owns, not just a piece of paper. So your term. In a summation of intelligent investor, Benjamin Graham wrote, investing is most intelligent when it comes business-like. I am a better investor because I am a businessman, confesses Buffett. Buffett purchases a type of companies that he understands. One that possesses good economics and is run by trustworthy managers. So, hope you enjoy this video and understand what are the 12 immutable tenets in buying a business. How Buffett thinks before he buys a business. So, if you felt this video is useful, make sure show your love by hitting the like button and subscribe to the channel to watch any further contents of this book and other books of financial thinking. Until then, it's a bye from Bala. Keep learning, keep earning. Bye.